Thanks for tuning into Talking Point. I'm your host Neeraj Shah, and on a day like this, not just purely because of the market reaction, but even otherwise, by virtue of the fact that inflation is still running red hot and geopolitics continues to be center stage, it's ideal that we get arguably the largest money manager sitting out of India or out of India sitting out of Singapore joining us on the show today to talk about his thoughts on how he views the landscape. Prashant, great having you. Thanks so much for joining in. Good afternoon to you.
My pleasure, Neeraj. Good morning to you, and thanks for having me here on your show.
The pleasure is ours. So, Prashant, how do you look at the landscape? I mean, the scares around inflation are not going away. Today, Reuters was reporting that US might be considering some sanctions against China to deter it from taking some action against Taiwan, and Russia and Ukraine continue to be on 5 months, 6 months out. How do you view the investing landscape?
Certainly, Neeraj. So, if we were to think into, there's quite a dichotomy right now between the macro environment and how people are viewing macro around the world versus how people are viewing macro in India. Indian businessmen, Indian investors within India, as well as foreign investors and foreign businesses when they view India, right? Quite a dichotomy. Real or not, whether that time would tell, but at least markets right now believe there is a real dichotomy. So globally, all the stuff that you mentioned, all the items that you mentioned, they're more relevant globally than in India. So Russia-Ukraine war, is, let's say, so there's a direct effect and second order effect. So second order effect is there on India, but the direct effect, if we were to talk about initially, then there is no direct effect of the Russia-Ukraine war. If anything, there are people arguing globally that India might be unjustifiably taking some benefit from that. I don't necessarily agree with that. It's not that India is merrily, looking to get cheaper oil and make something out of this geopolitical situation, as some might portray outside of India. But there is not a direct downside like there is in Europe, as an example, where they are indeed suffering from a variety of aspects of the fallout of the war. Most particularly the energy prices, the natural gas prices, which have gone through the roof, and energy bills have gone through the roof for individuals as well as for corporates. So that kind of an issue is not there in India. The China-US trade sanctions and whatnot has been going on for quite some time, as you very well aware from Trump time period. They accelerated. And yes, there's an added dimension more recently, which is related to Taiwan. So that again, but does not impact India. If anything, impacts India positively. The direct impact or second order impact, both are positive in this case for India, because whether or not you are as a global corporate directly getting impacted by any of these sanctions, right? This does prompt you as business leader or as board of directors of these global corporates to ask questions of their management and what is the business continuity planning? What is the strategy for a situation where things might get out of control? Because see, there's one is the Russia-Ukraine war has heightened the sensitivity to geopolitical tensions all around. So what is the contingency planning in case something like this were to erupt in Asia between China and Taiwan? That, and at the same time, the further sharpening of these sanctions against China from US also prompts or further intensifies the debate of alternative sourcing, which has been going on for many years, which had one degree of intensification under Trump, and rather than getting any relaxation after Trump, it has only gained further pace. So because of that, obviously, when people think of China plus one, they think of various countries, and India is one of those leading contenders amongst those. Obviously, there are others like Malaysia, Thailand, Vietnam, Indonesia, and so on and so forth. But India is also one of them. And given the scale of China, even a small diversion from there to other countries in the region is a big positive for these other countries. More recently, last week or two, in fact, we're starting to hear people talk about Europe plus one strategy. So we were just talking about China plus one for a long time, but now apparently corporates are, and these are, Indian corporates talking about, what they are in actuality hearing from some of their clients and prospects. And these are clients and prospects from Europe. It's not American or elsewhere, but they are worried about their own supply chain. So if a European corporate ABC is buying some intermediates, or raw material from other European companies, say XYZ, the buyer is worried whether there would be continuity of supply because of what's going on in the energy with the energy crisis in Europe. And we have all heard of a lot of shutdowns in various sectors in Europe. So this Europe plus one is a added element that we've been hearing over the last few weeks. So India again, I think, is a different situation from the current macroeconomic environment in a lot of ways than what's going on globally. Obviously, there are certain factors like overall inflation pressures that you cited that impact India as well. The rising interest rates globally, including in the US, that is, initiating from the US, if you will, that is, and across the world, including Europe as well, that also impacts India. But again, when you think of high single-digit inflation in India, it's not something we are not used to, not accustomed to, right? Our average inflation over the last 20 years has been 5% or thereabouts, right? So a 7-8% inflation for us is something we have seen before several times over the last 20 years, right? Which is where inflation is running right now. Whereas for Europe or US, which are accustomed to low single digit or 0 to 1% inflation for the last many years, a 7-8% inflation is a big bolt, right? Or a big jolt, and something that they've not seen in a very long time. A generation has not seen in a long time. So hence the impact or the negative sentiment around that also in India is at this time fairly minimal, and the actions that the RBI have taken till date has managed to have some containing effect on those pressures. So that's how I would put them into two separate camps: what's happening in India versus what's happening globally.
But even if, and I have a follow-up to the fundamental piece as well, but even if fundamentally there might be a lot of positives for India, we surely can't, we can't say that India is decoupled from the technical factors, right, Prashant? And if higher interest rates, if has an impact on liquidity, if not already, and QT as we see it for the first time in so many, can that have a technical impact on markets worldwide and thereby emerging markets and India as well? Never mind how strong India might appear.
Absolutely, absolutely true, Neeraj. No country in today's day and age is decoupled completely, right? It's just that the relative degree of India's interdependence on what's happening globally is much lower. So to the extent, it is low, let's say, just make up or use, let's say, India's trade as a percentage of GDP, which is in the 20s or so, compared to most other Asian countries, which might be in 50s or so India's interdependence is lower. So that segment will get negatively affected, like IT services exports are going to get negatively impacted because there India is not benefiting from China plus one or Europe plus one. India was the one and remains nearly 100%, right? So there would be, and hence you see in the equity markets as well, IT services is down 25% plus or thereabouts, including today, whereas the market is up positive territory. So IT index has underperformed the broader benchmarks by some 27-28%. And yes, there is expectation that if there is globally a downturn and there is recession in the US, then there might be some containment of spending. But we are talking about on balance. So there are these pockets of negative hit. And to your point of, yes, the liquidity, interest rates and all, these are tactical matters, as I've often maintained, and near term would have a negative impact. But again, the impact would be lower in India than elsewhere. From a technical perspective, at least as of now, let me correct myself and say, as of now, it is having a lower impact on India. Because India is being also, because see, there is obviously money to be invested. Still, there is an existing stock of money. Maybe the inflows. So if you look at GEM, for example, there's existing stock of trillions of dollars in GEM. Even if inflows may be lower, or there might be outflows as well from GEM because of all these considerations. But within that stock, India's position is increasing. India is just like corporates are considering India as a stable environment to procure from. I mean, geopolitically, amongst emerging markets, India is considered most stable at this time, right? So similarly, for investors, there is no China-Taiwan related kind of issue, at least at this time. You know, from a political, internal politics perspective, there is stability that people or corporates as well as investors are expecting to continue, and hence there is a bit of a safe haven like attraction within the context of EMs towards India at this time.
Got it.
Also, other countries, like, you know, we talked about China, but obviously Taiwan is part of the same equation. So South Korea has a lot more dependence on China and overall a lot more interdependence with its technology sector on global economy. So if you look at large buckets in EM, what are the 4 largest buckets in EM that make up double-digit percentage of EM benchmark, right? China with around 30% is the largest. Then India is now become second largest at about close to coming up to 15%. And then Korea and Taiwan, which are in the low to mid teens. These 4 make up 2/3 of the or more of the benchmark. And if you just look at these 4, India is clearly outshining at this time.
Prashant, you would have deep knowledge of this. We've obviously heard of EMX China funds. My question to you is, after the barrage of outflows that we saw in the first half, the last 2 months, the inflows that we've seen, is it a result of such factors, EMX China, and then money moving out of Taiwan and Korea, chip makers, etc., coming into India? And does that have the potency to continue?
Certainly, I think it's partly that. But Neeraj, my belief has always been that performance draws or sucks in inflows in any variety of forms. So the fact that Indian market has done well relative to GEM, again, GEM is down, if you look in dollar terms, more than 20% year to date. Indian indices, MSCI and all, in dollar terms is down low to mid single digits. So that outperformance itself draws inflows, and that has been further aided by the funds that we talked about, GEM ex China now, are fairly modest in size. But yes, those are all gathered over the last few months and all, and hence may add up to a more material amount in the context of flows. That element, I'm not sure how sustainable that is. China, I mean, Asia, remember, at one point in time, there was just Asia funds, and then Asia ex Japan became the predominant fund.
Yes.
That was after Japan became a developed world. Developed world country, right? With China, for that to happen, like people starting to think of GEM ex China, it would be more when China becomes categorized under developed, which is long way off. South Korea itself, which is nearly twice the per capita, is still in the emerging market. So this ebbs and flows. Sometimes these kind of products find favor when a particular country, large as China, is doing very badly. If you have a good year in China, people would no longer want China as GEM ex China.
Got it. So Prashant, tactically, I mean, I'm guessing on your funds, you would probably not be taking too many cash calls, if at all. But if you had a choice, Prashant, tactically, if you were running a long short fund, or if you had a choice to make a large cash call on a personal account, would you do that currently?
No, in fact, I'm doing right now just the opposite. In that, whatever cash is there in terms of, on the balance sheet of the company, if you will, very eager to get it invested. And the utmost, obviously, you have to keep some working capital and all that, but otherwise, eager to get that invested. But that's always the case with us. We never take cash calls. Cash in the pocket does feel like, I know there's a very famous saying, cash doesn't burn a hole in the pocket, but to me, it always feels like it's burning a hole in the pocket, and I never like to keep cash in the pocket or in the bank.
So that's because of policy continuity of your firm per se. But would you believe that there could be substantial downsides for Indian markets, or you ruling that out? Surely you're taking some hypothesis when you are getting your money invested.
See, in equity markets, first of all, what is substantial downside, right, is a question.
Let me say northwards of 10%.
At any given point in time in the market, over the past 30 years, 40 years, if you had asked me the question, or at any time during equity markets, by definition, I mean, 10% is always on the cards.
Come on, Prashant. My viewers are watching for some direction from you. You manage such large noodles of money. Tell me something.
Not in a single day, but in any given month, 10% is possible. The longer the time horizon, if you ask me over the next 10 years, can the market be down 10%? Highly unlikely.
Sure.
There have been hardly any instances of, there have been some, but like from peak of 92 to bottom of 2003, the markets would have been down. More than 25%, if I recollect correctly. But is that like forget even base case, that's like I don't know what kind of a sigma, even 3, 4, 5. On an expectation basis, our expectation always is that the market should deliver over any reasonable period of time in line with nominal GDP growth. And over a shorter time period, nobody has any better clue. So then, over a shorter time period as well, the best ex-ante expectation is to expect low double digit in line with Indian nominal GDP, rupee growth or return from the market.
Okay. Let me try and rephrase. Do you reckon we had a bit of a pullback from those lows of 15,300, 400 odd at current valuation, circa 17,500, 18,000? Do you reckon earnings catch up will make valuations look reasonable, or GDP growth will make the market cap to GDP maths look reasonable in the next 12 months, or will the markets have to kind of move sideways and wait for a considerable period of time? What's the analysis there?
Sure. So just to complete the previous answer as well. See, the risk is higher at this time, no doubt. So the expected return doesn't change, which is in line with nominal GDP growth. And that would mean, low double-digit return going forward. But the risk is higher, and simply the risk is higher. Risk is always there, but risk, if you want to take, I use very simply a very, objective measure of risk, which is look at the VIX index. VIX index year to date is up 58%. Just yesterday went up 14%. Not surprising if Nasdaq goes down 5%. VIX index up double digits, not surprising. The fact that VIX is higher and has, of late also spiked up. So obviously, whenever VIX is higher, the risk is, market is saying the risk, in market man's perspective, the risk is higher. But risk higher does not necessarily mean that the downside risk is higher. Both risks are higher, downside risk as well as upside risk is higher, and the expected outcome to us is still that nominal GDP growth linked return. Now, to your following question, I'm sorry, Neeraj, can you just remind me what was the following question?
Now, I was just asking, will the markets have to move sideways for the valuation catch up to take place, or do you think earnings or growth will gallop?
See, if we look at the market right now, it is in absolute India relative to India only. If we forget the global markets, because valuation, either you're talking about, I'm not a believer of absolute, anything like absolute value, but relative valuation you have to look at. Obviously, when people who say absolute, that also is linked to what are the interest rates. You can't have all else equal. You can't have the same. And when people talk about valuation, they're talking about P multiples. You can't have the same P multiple expectation when interest rates are 15% and when interest rates are 4%. Okay, all else equal. When interest rates are 4%, multiples have to be higher. So when people compare multiples, let's say globally over the last 40 years, that's not or 50 years, that's not a fair comparison, because the current interest rates are far lower than the average interest rates over this time. But coming to India multiple relative to its own self, if you look at right now, we are not much different from where we have been on average over the last 8 years, Neeraj, in terms of P multiple. Again, if we keep, let's say, take an average of last 30 years, then we are about 20% higher. But again, we are talking in different interest rate regimes. Over the last 8 years, or at least the Modi era multiple, we are, at more or less at par with the Modi era multiple, which has been a 15-20% premium to the very longer term multiple. Relative to the global market, particularly global emerging markets, yes, India is towards the higher end at this time, but it is more because China has gone down so much. China has re-rated over the last 2-3 years because of everything that we already know, and not need to rehash. But China was 35 to 40%, closer to 40%, I think, a couple of years ago. So if the largest component derates by as much as it has derated, the overall GEM multiple has gone down. India multiple hasn't necessarily gone up, but the relative difference has increased. And also remember, Russia has gone to zero over this time. So Russia has to gone out of the index. That doesn't play much of a role because Russia anyways was a far lower multiple within the GEM index.
Got it. Okay. So Prashant, we've taken about 20-25 minutes of your time. My one final question, therefore, because I wanted this to be a macro construct, I'll slip in a small micro towards this end now. I heard you mention that you are actually trying to invest every large cent within the firm into the markets, or looking for opportunities thereof. We've had multiple conversations with Ramesh, for example, talking about how does he believe the whole fund wants to invest, in what pockets, etc. We know about your theories of bifurcating the company into OpCo and FinCo. Within all of that construct, where is it that you've seen material new decadal or long-term opportunities emerge from your horizon? They may take place 1 year down the line, they may be there right now. Where is it that you see that long-term opportunity?
So just to be clear, we invest entirely in the funds that we manage, right? So we have investment. We do manage now a global emerging markets fund from Singapore. So a good part of the investments are going into the global emerging markets fund, and good part of the money is also in the India funds. And in both the funds, we find opportunities just as so these are funds that we manage for all investors, and we are pari passu with the investors. So in India, if I were to talk about the most opportunities we find in private sector financials, which has always been pretty much the case, and then the team finds a lot of opportunities in consumption space in general, which is discretionary as well as staples. And then third area, I would say, so both private sector financials and consumption is entirely domestic oriented. And then we do find opportunities as always in export oriented companies, particularly in IT services, despite the troubles that they've had, and we had to take the hits in some of the names that we own. But at this time, where the names are, we continue to find and like and own several of them. And besides that, within that category of exports, obviously, there's also chemical companies and some of the pharma companies which have presence both domestically and outside India. And in the global context, I don't know whether that was a question, but in the global context as well, they're less so in financials because financials, India has the best opportunity set besides a couple of other like LATAM countries or like Indonesia, Peru. There are pockets, but large segments of global emerging market financial sector, we tend not to, like in China, South Korea, Taiwan and all, we don't have investments there because not as good or attractive a sector. But IT, technology sector, as well as consumption again over there are bigger opportunities that we find. Technology includes leading companies like Taiwan Semiconductor and others. Not necessarily that these companies are in the portfolio, but I'm saying those kinds, not just IT services per se, but also hardware companies is the point I'm trying to make. And software product companies as
well. Got it. Prashant, always lovely getting this macro view from you. Thank you so much once again for doing this and look forward to seeing you more often.
My pleasure, Neeraj. Hope to see you soon.
Yep. Thank you, viewers. Thanks for tuning into this edition of The Talking Point with Prashant Khemka.